Thanks, everyone. Thanks for having me here. So today I'm going to talk about central bank digital currency. So this is a joint work with Tony Whited and Huang. So in particular, in this paper, we want to study a question that central bankers and researchers have been had a heated debate on in recent years, which is, will central bank digital currency disintermediate banks? So Zhigu and I had just had over the lunch had a essentially discussion. So he was telling me that when he was in China, he was asked by the top central bank in China about exactly the same issue. So hopefully our paper can shed light some of these questions. So first, let me define what is central bank digital currency. So a central bank digital currency, or CBDC, is a country's official currency in digital form. Okay, so you may say, we already know, we already have digital money, like the bank deposits is digital. What is special about central bank digital currency? So central bank digital currency is different from existing digital money like bank deposits in the sense that CBDC is a direct liability of the central bank rather than that. So essentially, you can think about you essentially open up accounts not with JP Morgan Chase, but with the Federal Reserve, right? So when you deposit money, you show up on the Federal Reserve balance sheet instead of showing up on JP Morgan's balance sheet. And this is going to have a very important implication on lending, which we're going to talk about even later in detail. And the CBDC also differs from existing central bank liability, like bank reserve, because CBDC can be held by the general public, not just banks. So in the sense that CBDC is a proposal that you and I can open up accounts with Federal Reserve, just like those big banks. So, what we're talking about here, as I mentioned, CBDC has been a kind of in policy debate in recent years. 86% of the central banks are investigating the potential. 14% of the central banks have actually launched the pilot stage. So why we are kind of talking about CBDC, firstly, central bankers think about there are some potential benefits in the sense that because the kind of the physical cash has been kind of outdated, and they are worrying about as time goes by, they lose monetary policy control. So they want to kind of roll out something new to make sure that central bank is still relevant. And also, there's concern, especially in the US, that commercial banks have too much market power, so they want to essentially offer a public version of, bank accounts in a sense to compete with private banks. And also, people talk about improving financial inclusion because there are a lot of people are unbanked. So at least they have a central bank as. However, this is not what our paper is going to talk about, the benefits. We're going to focus on the kind of the pushback, which people often talk about when we talk about this policy proposal, which is they worry that central bank digital currency going to disintermediate banks and reduce credit supply. So here's a quote from the Federal Reserve white paper, which says that widely available CBDC could reduce the aggregate amount of deposits and raise credit costs for household businesses. So what exactly is this concern? Let me use a graph to explain, what people are worrying about. So you can think about this as kind of a simplified version of aggregate balance sheets for the US economy, where we put our liquid wealth into bank in the form of deposits, and then bank can make loans to firms, which convert to real investment. Right? So now if a CBDC is introduced, so as a household, instead of putting our money in commercial banks, we can essentially use the Federal Reserve accounts, essentially we're holding CBDC. But what is different between a private bank and central bank is that the central bank, like the Federal Reserve, has no interest or technology to get into the lending business. And so you can think about they need all the loan officers, all the credit risk models. So, and also by law, they are not allowed to take any credit risk. So what they can do is, if they have money that raised from CBDC, they're going to park in the treasuries. Right? So essentially, the worry that people have is that if you have $1 trillion of deposits that migrates from commercial banks to central bank, who is not lending, then the credit supply in the aggregate economy is going to drop. And this is kind of a big concern and a big pushback to implement CBDC. And this concern is made very clear by a quote from a private lobby group. Essentially says that even the average loan to deposit ratio for banks is generally 1-to-1. So every dollar that migrates from commercial bank deposits to CBDC is one less dollar of debt. So in this paper, we're trying to essentially think through both the conceptual underpinning of the statement, whether we're going to see 1-to-1 drop in lending, and also kind of the quantitatively is 1-to-1 the right number. So specifically, conceptually, we will make a very simple observation, which is, deposits, although it is kind of the average source of financing for banks, but it is not only source. Actually, if you look at the largest bank in the US, they routinely use wholesale funding to make up any deposit shortfall for lending, right? So our argument is that, in absence of any frictions, if banks can costlessly replace deposits with wholesale funding, then actually the introduction of CBDC and the loss of deposits will have no impact on bank, because banks gonna essentially use the wholesale funding to make up the shortfall. And then we can actually make this analytical result essentially in a simple model. We can show that deposits and loan are separable in a frictionless benchmark. Essentially, you can think about this as a multi-denominator in the banking. These two kind of branches of bank business does not have to be made under one roof if there's no friction, right? So now, what is kind of the implication of this irrelevance result? This irrelevance result shows that the implicit assumption underlying many existing discussion of CBDC is problematic. Let me just remind you, what people say is that given, the loan to deposit ratio is 1-to-1, so one less dollar of deposits is one less dollar of lending. However, this is essentially confuse the average source of financing with the marginal source of financing, right? So again, as I just talked about, in absence of any frictions, the right benchmark we should think about is 1-to-0 instead of 1-to-1. And kind of the right way to think about the impact of CBDC is what are the frictions out there that essentially bind deposit making and loan origination together, so that we move away from the 1-to-0 benchmark to something positive, right? So that is essentially what we're going to do in the second part of the paper, which is we're going to think about what are the real life frictions in the banking system that bind these two big lines of business together under one roof, in the modern. So the first friction we can think about that connect these two sides of balance sheet is external financing friction, in the sense that wholesale funding is uninsured and subject to friction. So, bank therefore cannot frictionlessly replace the lost deposits that is competed away from CBDC with wholesale funding. Right? So if they finance themselves with 90% of the wholesale funding, we all know what happens to SVD. All right, the second friction we think is empirically important is capital requirement. So, given CBDC's competitor for bank deposits, which is big contributor of bank profits is going to go down, and the bank capital gonna fall, and it's going to constrain lending capacity. Okay, so and that can also have implications of bank lending. So lastly, we also know that in the real world, banks are borrowing short term and lending long term that subject themselves to maturity transformation and interest risk. And in that sense, deposits are special because deposit rates is very sticky and it functions as a natural hedge of interest risk. Now, if the central bank digital currency compete away a large chunk of retail deposits, and of course, banks can replace some of them with wholesale funding, but the interest rate of wholesale funding essentially is follow 1-to-1 to the bond market, and that's going to expose banks to a huge amount of interest rates. And again, this is going to make banks want to keep more deposits, and if they don't have enough deposits, they're going to cut them. So essentially, we're going to have a full structural model that incorporates all of these frictions. Specifically, there's going to be a dynamic industrial organization model of banks in discrete time. Why we want an industrial organization model? Because we want to think about competition. Why dynamic? Because we want to think about interest rates. So we're going to have depositors choosing where to invest their liquid wealth. They can choose, each bank of the deposits. They can choose physical cash, and in the counterfactual, we're going to introduce CBDs. So here, I'm going to talk about a little bit more how we think about competition. So here you can think about a product in the deposit market. is a bundle of characteristics. So that's kind of IO economists, how they think about competition. You can think about, for each product, you can think about what's the rate of return, whether, this product links to some physical branches where you can get some convenience withdrawal from ATMs. And also this allows you to conduct transactions, right? So if you have saving deposits, you cannot write a check on it. If you have a checking account, you can, so on and so forth. And also depositors, they exhibit different sensitivity to each characteristic. So in the sense that, you would be willing to trade off some of the return with convenience. So that's something we're going to estimate. And the borrowers are simple. They're going to choose how much to borrow and where to borrow, given the rates. And the banks, they're going to choose the rates, both only in their lending side, as well as in the deposit side, subject to the three frictions I just mentioned. And also, if they don't have enough deposits, they can go to the wholesale funding market and to borrow wholesale. All right, so we're going to, as I said, here we want to kind of bring this policy work debate into kind of confront it with some empirical data. So what we're going to do is we're going to structurally estimate the model using two stages. Firstly, we're going to estimate the deposit of loan demand via a BLP, which is a workforce estimation model procedure in the IO literature. Essentially, what does this stage is helping us to do is kind of to pin down the sensitivity for the average US households to say, the rate of return, to the convenience, to the number of branches, so on and so forth. Okay, and essentially this is going to give us a demand system for different type of products. And in the second stage, we're going to estimate the parameters that governs the financial friction via a simulated method of movement. So essentially, how costly for banks to go to the wholesale funding market and borrow money, right? And essentially, the way we do it is that we're going to choose a set of parameters such that the banks in the model behave as if they are the real bank. And of course, in the US, we don't have CBDC yet, so you're going to be absent when we estimate the model. We're going to introduce it later in the context. However, here I just want to emphasize that, to really kind of understand the impact of CBDC, as I said, is actually a question about banks' friction. So we already observe banks and how, manage their rates, manage their quantity of wholesale funding in the historical data. So we can get a much good, pretty good idea of how banks gonna function when they are essentially facing a new entrance. So now let me kind of move to the counterfactuals. So essentially, we're gonna model CBDC as a new bundle of characteristics, which is they're gonna offer some rate of return. We're gonna consider different policy proposals. You're gonna offer the same transaction services as checking accounts. This is probably the most likely thing gonna happen in the US. And also, you're gonna offer some convenience, which require quality. So essentially, we're gonna use the estimated issue of fixed effect from physical cash and adjust it by a digital premium. So here, first we're gonna consider two kind of types of CBDC. One is a non-interest-bearing CBDC. Well, you can think about as a cash-like CBDC, right? So you can use that for transaction, but it does not pay you any interest. So we're gonna also think about an interest-bearing CBDC because in the sense that the central bank gonna remunerate some interest payment to you when you have a balance with them, and require it to deposit that. And on the asset side, the central bank is essentially gonna invest and raise funds from CBDC internally. And again, as we mentioned, because central bank does not have the technology to do lending, so that's the most likely thing to do. All right, so now let me first ask the first question, which is, how does the CBDC, kind of introduction of the CBDC affect the industrial organization of the US banking system? Think about the market shifts. So the gray bars are the current, equilibrium. So what's the current banking sector look like? Of course, there's no CBDC, so the market share of CBDC is 0. So 7% of the market share is physical cash, and 88% are bank deposits, which we lump both saving deposits and transaction deposits. And the rest are outside options like money market funds, treasury bills held by households. All right, now we introduced the non-interest-bearing or cash-like CBDC. So here in equilibrium, this cash-like CBDC is likely to claim 8% of the market, not that high, and around 1% is coming from the cash, and around 7% is coming from the bank. Okay? And at the beginning we thought this seems to be quite low because it seems that everyone is talking about CBDC, but why it's not that appealing? But it turns out that in China, when they introduced this kind of cash-like CBDC, the take-up ratio is high. So we feel quite happy about that. We didn't really predict a very high take-up ratio for this cash-like CBDC. So secondly, we consider an interest-bearing or deposit-like CBDC. Here we consider the extreme case where they pay the prevailing market interest rate, like the Fed fund rates. But you can also think about they pay 50% of the Fed fund rates that are going to be somewhere in between. But again, if you consider this deposit-like CBDC in the equilibrium, they're going to claim a third of the deposit market, right? And this is very large, right? Think about the size of the deposit market in the US. That's 20 trillion, around 20 trillion now. So we can think about the Federal Reserve balance sheet going to explode by 7 trillion if they decide to, issue an interest-bearing CBDC that pays the Fed fund rates. And they're going to have a big headache to think about, where we invest this 7 trillion of money. And also, the cash going to be further decreased, but most of the market share for an interest-bearing CBDC that going to steal away is from bank. So the bank is going to lose tons of market share. So in this graph, what I'm showing is on the margin, right? So before I look at the level, now I'm looking at on the margin, if we marginally increase the market share of CBDC by 1%, how does that affect different outcome variable for banks? So the first one is deposit spread, essentially is how low the deposit rate is relative to the market interest rate. You can think about this is what banks make from charging depositors by paying below market. So you can see that when a central bank introduced a non-interest-bearing CBDC, right? So if we kind of marginally change the convenience of the CBDC by so that the market share increased by 1%, the banks can essentially lower their deposit spread by around 43 basis points. So essentially, banks re-optimize once they feel that, okay, there's a new competing product out there. We want to respond by lowering our price. Loan spread going up. This is because there's a huge outflow around 82 cents per dollar from the bank. So there are not enough money to lend, so they have to cut their lending here. So the loan spread in the equilibrium. So essentially, banks are going to try to charge more because their quantity decreases. We'll also see that here, we are looking at the quantities. So $1 of CBDC is going to compete away 82 cents of deposits, 11 cents of physical cash. And at the end of the day, the impact of lending is around 19 cents. Right? So here, I want to remind you that the earlier discussion among the policymakers and the practitioner, they are worrying about $1 of CBDC. $1 loss in deposits is going to lead to $1 loss in lending. So what we find is that, empirically, this number is likely to be much smaller. It's likely to be around 1/4 of that effect. So here I'm looking at the interest-bearing variation of CBDC. And again, this effect is actually quite comparable on the margin, although the level is quite different. So the interest-bearing CBDC is going to have a bigger impact on the pricing of the deposits. Their impact on the deposits is actually similar. Their impact on the lending is larger. Their impact on cash is smaller because interest-bearing CBDC, as we mentioned earlier, is more deposit-like. So you will have on the margin a larger relative impact on deposits than cash. So we also look at different subsamples on large banks, small banks. We find that the impact on deposits are similar, but the impact on lending is 3 times larger for small banks because small banks face larger external financing frictions. And the impact is larger in more competitive markets because banks do not have market participation. So lastly, we also think about the financial stability implications. So here we simulate a default shock in the size of 2008 financial crisis. What we find is that when CBDC is introduced, the banking sector is going to have a harder time more banks gonna default, they're gonna take longer to recover, and then lending. And this is because CBDC gonna decrease banks' profitability, make banks capital thinner, so bank sector gonna suffer. And in response to kind of this worry that the negative impact of CBDC on banks' profitability, actually there's another proposal people just come out saying, why should we kind of exclude commercial bank in the whole enterprise by issuing this direct CBDC where us like household interact directly with central bank? Why can't we have commercial banks as intermediary, right? So they help the central bank to manage CBDC, and central bank can pay some fee to the commercial bank so that everyone is happy because the profitability impact is going to be much alleviated. So here's a quote which says, essentially putting that, which says, this intermediate CBDC is going to be great because it's going to minimize these destabilizing disruptions in the existing banking system. However, the last result I want to share with you is that the intermediate CBDC is going to actually have a much bigger impact on lending. The intuition is that even if the CBDC is intermediated by some bank, but it's essentially going back to the central bank's balance sheet. So the impact on lending is the same. However, because now you can go to branches to manage your CBDC, it becomes more attractive. So there are going to be larger deposit outflows from commercial banks to central bank. So the impact on lending is actually much larger. So I'm running out of time, so let's just conclude here. In this paper, we ask, will central bank digital currency be safe? We find that you will have a huge impact on deposits, but the impact on credit supply is much lower than what is commonly believed. Thank you so much.
First, I would really want to thank the organizers for inviting me to discuss this very interesting paper. I learned a lot. So the paper estimates a banking model to quantify the impact of a potential CBDC introduction. And the model features these transactions, fixed effect is the quality of cash transactions deposited CBDC. And they are trying to get at the difference between retail funding and wholesale funding. Deposits will be insured, so they need to model the bank's default process. So the result, the CBDC market share will be low, but the substitution of bank deposits is super sensitive. $1 CBDC will substitute 80 cents deposit, but that would only translate into 19 cents of reduction in bank lending because bank can substitute to this wholesale funding. I think it's a very ambitious question. I'm not a structural person, I'm a theorist, but I still think it's a very skillful execution and also allows for tractability. My main comments is in a baseline, I think CBDC is closer to deposits rather than cash. And I have some thoughts on interpreting the results, including a response to Daryl Duffy's comment on this paper at the Summit Institute. Okay, so let me take 2 pages for the model. Okay, 2 pages for the model. So the quality would depositors and savers, so the quality of the products will include this transaction dummy. And retail deposits are insured because this yield is just a price proposed by the bank. So in the event of bank failure, there will be some outsiders, FDIC, do the injection, and the retail deposits never suffer loss. And borrowers, financing options will be long-term. They are really trying to get at this maturity mismatch. And this will be the short shock and bank losses into the system. And for tractability, there will be some exogenous delinquent portion per period. So the banks, first they are setting the rates to optimize this period's operating profits. So market clearing will happen at deposit and lending markets. So the banks take the demands of loans and deposits given, and they also choose whether to do. So if the continuation value, and here you can also see the state variables, federal funds rate, delinquent proportions will be somewhat exogenous. and loans and equity. So banks will endogenously choose whether to default, and this will be priced by the rate of uninsured wholesale funding. The probability of default and refi. Okay. So my first comment is in the baseline. I would think CBDC closer to deposits. So in the counterfactual, the yield of CBDC is exogenous. The quality of CBDC is treated as cash, transaction stemming, and plus some digital convenience adjustment. This is important because looks like it's driving the market share of CBDC. Previously, cash is 7%, and after the enrollment of CBDC, now CBDC is also 7%, and this is the crowd out part. I would say, yeah. In the author's thoughts, I would think that both cash and CBDC are government issued, and if you think of Professor Koda's "This Money's Memory" view, both of them are memoryless. CBDC restores some privacy. And in the IO view of banking service, the quality of deposit would include banking characteristics, and all my banking services are here, so I put my deposits here. But in practice, CBDC is implemented by this two-tiered operating system, and Kairong also mentioned in the model extension. So in China, instead of individual opening a eCNY, which is the CBDC in China, directly at the central bank, what they actually do is they go to their commercial bank to open the digital wallet, and this wallet function will also be embedded into these commercial banks app, and the commercial bank hold the CBDC or eCNY at their accounts at the central bank, and fully backed by reserves. And so there are some fancy crypto things going on so that the intermediaries, the commercial banks don't see the transactions. Okay. So perhaps the baseline model captures more on the private currency, like stable coins and etc. The second comment and the third comment is about interpreting their results. So the answer of this paper is, the message of this paper is, yes, there will be there will be reduction in deposits, but this doesn't translate to a lot of reduction in lending because the commercial banks can substitute to wholesale funding. The first reading of it, I was thinking, does this suggest our commercial banks are enjoying a lot of buffers or rents, and they may do just as well by substituting 3/4 of the loss to wholesale funding? The special thing about banks is they're depository institutions, and in the aggregate, they have sleepy depositors, and they are so special in credit transformation and maturity transformation. So I was thinking, why do we need banks? Then second thoughts, I think the exercise can be connected to two other important questions. First, I'm really, really curious about when does this substitution fail to work. At the extreme, they cannot be fully substituted. If the banks fully substitute to wholesale funding, are they still banks? So I think it's more like from a regulatory perspective, are we giving too much subsidy to the banks? But you need to be more careful because the wholesale funding side is currently modeled as federal funds plus some default spread. And if you have a large aggregate quantity of substitution, I think it's very difficult to think about the general equilibrium or market clearing on the wholesale funding market, but maybe some convex costs will do. The second is maybe you can connect to the rise of market-based intermediation and the blurred line between banks and non-banks. The modeling of this paper, the asset side and liability side are still relatively separate in the sense that it's not talking about some synergy like commitments of lines of credit and demand deposits, still relatively separate. So if you take this model, there is a good substitution to wholesale funding. Maybe you can explain banks are behaving like non-banks on the liabilities. Gregor has a lot of work on this when banks stop doing balance sheet lending. And if you think about non-banks who don't have deposit funding, they're taking some of the assets out of the banking market. There is the widening middle market taken by private debt. And the really small retail side, fintech is picking up a lot. So my last comment is a response to Daryl's comment. So what about the relevance of narrow banking? Would a central banker really implement CBDC at the risk of narrow banking? But narrow banking is actually already happening in China. So we are in this cashless economy with Alipay and WeChat. They are not banks, they're tech giants. And starting 2019, the wallets are fully backed. So potentially it's a narrow banking economy without massive disintermediation. Maybe what's going on is very efficient settlement and greater liquidity and money velocity, but this is an open question, but hope this helps to address Daryl's comment. Thank you.